Hi everyone, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in a week ahead. So whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format for most of you guys who know how we roll with this. So every Monday at this time, we just look through what's been happening and what is about to happen. So we'll first just check out how markets are trading currently. It's obviously a UK bank holiday, so that's affecting liquidity in Europe a little bit. Although obviously we get the US opening in a few hours' time, post, of course, Jackson Hole and Fed Chair Powell's speech from Friday. So a fair bit to digest from that. Before that, though, we'll look at just how markets are trading currently. We'll look at stock markets and Nvidia earnings and go into some detail around what is expected for those earnings after the US close on Wednesday. We'll look at the chart as well, the technicals on that. Then we'll just check out, of course, in more detail, as I said, Fed Chair Powell's speech from Friday from Jackson Hole, and the pivot, really, probably a better word we need to use than pivot, probably flip-flop, I think some people are using, just on the change of heart, really, change of view that we heard from Chair Powell and the endorsement pretty much of a September rate cut by the Fed. So we'll look at that in detail. Then we'll look at some of the other bits of data and the central bank meeting from last week as well. So UK CPI important for sterling. We'll look at the RBNZ meeting as well. So we'll look at Kiwi against the dollar and also some PMI data as well last week. So a fair bit from there. And then we'll look ahead to this week's main events. A lot of CPI data, inflation data out actually from the US, the core PCE data on Friday. We also get Australian CPI and Tokyo CPI as well. So we'll look at all the corresponding majors. So Aussie dollar, dollar yen, the DXY chart, cable, so sterling against the dollar, Kiwi dollar, and as I said, DXY chart, as well as a few graphics in amongst that. So after, just looking through the disclaimer, here's, exactly what I've just said, what we hope to cover in the next half hour or so. So markets generally, European bourses pairing some of those gains that we saw on Friday after Powell's speech. US equity futures slightly in the red, mixed really. And the dollar is making back a little bit of ground from Friday's losses of around 1%, actually. Quiet start to the week, as I said, as UK summer bank holiday. And the yen, just checking, is underperforming despite relatively hawkish leaning commentary from the Bank of Japan's Ueda around Jackson Hole, I think it was. US Treasuries, they're pausing for breath after Powell-induced upside, so yields move lower on the 10-year at least. And just checking, oil is very modestly firmer, was our focus a small bit on geopolitics, with gold slightly lower, with that dollar slightly higher. If we cut straight to actually Nvidia's earnings, we've got a graphic here with just all the main numbers expected and some interesting numbers around Nvidia generally. Of course, overall, markets hoping Nvidia's results can soothe fears about AI spending, of course, and effectively kind of confirm that the rally we've seen in the stock market isn't just a technology bubble, I guess. Nvidia is the biggest weighting in the S&P by far, really. It's now almost 8%, $4.3 trillion market cap, which I've got in here. As I said, around 8% of the index now. So its position really at the center of AI development has made it this kind of bellwether for the broader market as well. And just on that, if you think of the S&P 500, the top 10 stocks now by market cap account for around 40% of the index. Most of those are tech, probably some lower down, financials a touch, but Nvidia top of that pile, and hence why there's so much focus on it as big a risk event as sort of non-farm payroll even, and that type of event, US CPI, it being, of course, not an economic release, but a big risk event for markets. Close attention then, yeah, if we're digging into more detail about results, just before I get to sort of expectations on the numbers, yeah, there will be close attention on the quarterly metrics, but investors will also be focusing on commentary around the agreement recently struck with the US government that will see them take 15% of any China revenue. So some analysts, they expect Nvidia to post, well, strong July quarter results, but then they may guide cautiously for October due to those China-related risks. That means they might exclude China revenue from guidance, really amid several risks around that. So pending license approvals, you've got that 15% AI export taxes, and then pressure also on Chinese firms to use local chips and not NVIDIA chips. And for your guide without China, guidance then could miss consensus. Estimates, I think, make sort of China adding around $2 to $3 billion in sales. Apart from that sort of big question mark around, yeah, China, otherwise fundamentals do, of course, remain very strong. GPU supply, that rose 40% last quarter and should grow another 20%. Basically with well, the Blackwell, the B200 ramping, and then you've got the new Blackwell Ultra, the B300, which ships in October. So a lot of focus on that as well. Regarding expectations, just for you guys, a Q2 EPS that's expected at 99 cents. Revenues printing around $45.5 billion. Breakdown for that: data center by far the biggest revenue driver, above $40 billion. Then next best is gaming, actually just below $4 billion. So a tenth of the size of data centers, of course. And other metrics, well, gross profit margin, that's expected at 72%, operating expense at $4 billion. And then in terms of that forward guidance, well, just for your guide, next quarter's revenue is seen at 52.6 billion, EPS of around $1.19. And then full year revenue seen around, I think it's $201 billion, EPS of $4.37. So just some numbers around this bellwether, as we called it. If we just look at the charts then, or the chart, sorry, on Nvidia, only going one way really, as we've mentioned. Just bear with me 1 second. Yeah, just pull up the chart, which is there. As I mentioned on that graphic, yeah, the stock is up over 100, well, around 100% since Liberation Day lows, probably a touch more than that now with the rally on Friday. I mean, it's, yeah, climbed around 30% so far this year. Just pull up the chart. Sorry, bear with me 1 second. For my chart at least, which is here. Yeah, up 30% from those, no, up 100%, sorry, from the lows in April, up 30% this year. And the all-time high at 184.48. So we just dipped down sort of just below 170, I think 168.80, yeah, last Wednesday, and then a very strong candle that actually, if I just blow this up, you can see we dipped down to fresh lows, which we hadn't seen actually since sort of sorry, chart, just checking, hadn't seen those lows since sort of end of July, so around 4-week lows there, but then just finished marginally higher, and you can just see the projection really of those lower prices. And then we had a doji candle on Thursday before Jackson Hole, and then a big jump higher on Friday, well, 1.7%, and we're sort of now gunning for those record highs again at 184.48. Blue line there, just for you guys, the 50-day moving average. We haven't really tapped that since back in May. That comes in at 167. So those results come out after the US close on Wednesday. I'll be writing a bit about that on our daily commentary that we post after the US close. So I'll do a preview of that beforehand, and also look at options prices, which will give us a guide as to what markets are thinking will be volatility on the Thursday on the open after results on the Wednesday. And we'll get a grey market after those results as well, and give us a guide of where markets think Nvidia will open on that Thursday. Okay, moving on from that, actually, just before we move on, let's just check out some of the indices as well. So we've got the S&P 500, of course, just dipping slightly. We've still got in here this bullish channel, ascending channel, really higher highs, higher lows. We just dipped out of it, you can see, and we're sort of back in it after the rally, 1.5% rally on Friday again. The 50-day moving average, that's at 62.69, and then the all-time high 64.81, it looks like. And you can just see that ascending channel there, better on the weekly chart really, and the dip below, and then we're back in it again. So pretty likely that we just make fresh all-time highs again with this bullish momentum, even though futures, if I pull up that chart, slightly lower, so just below those record highs. We look at the Nasdaq, similar chart, really bounced back, although we're just we held this ascending trend line that I've got in here. We just dipped below it last week, but now above it again with those all-time highs just below 24,000, 23,969. You've got the 50-day moving average just below that trend line as well, upward trend line, just below 23,000 at 22,905. The Dow did make new highs. You can see there, really nice sort of bullish consolidation before this push higher, not up to 46,000, 45,757, a high from Friday, up 1.9%, and looking very bullish really, and not overbought either. Futures just slightly off, but still holding above 45,000. Let's just pull up the futures chart. You can see there, and above those previous highs as well, showing the open today. So still fairly bullish on the Dow now. Okay, moving on from stocks then, let's just pull up. Just a review of last week, and obviously Jackson Hole being the key event. If I just pull up, firstly, just bear with me 1 second. I'm just going to pull up the CME Fed Watch tool. Haven't looked at this for a while actually. So just for your guide, it's basically an analysis from the CME page. That's the biggest futures exchange in the world in Chicago. Sorry. It's the Fed Watch tool. So it analyzes the probability basically of the FOMC rate moves for individual upcoming meetings. So let me just pull this up first so I can show you. Really useful tool when you read about the odds of what markets are thinking for each meeting, then this tool is often cited. And if I just bear with me 1 second, you can just see it here. So hopefully you can see that. And up here you've got for the different meetings. So the next meeting, obviously middle of September, then late October, then mid-December. So 3 meetings left. And you can just see now we're currently at 4.25% to 4.5%. Chances of rates staying in that range, just 15% now, and then an 85% chance that rates go lower to the range of 4 to 4.25%. And if you just pull down here, there's lots of other metrics you can get, historical percentages as well. And you can just see here as well, a day ago, and then a week ago, and obviously a month ago, the different chances of that happening. Basically, the tool uses 30-day Fed fund futures pricing data, basically, which has been traded on all this time to express basically market views on the likelihood of changes in US Fed funds futures, which is US monetary policy. Really good visualization tool, so I recommend you having a look at that. It's the CME Fed Watch tool for your guide, and you can just see then we do move down to 4% to 4.25%, then what are the odds of a move from there down to another 25 basis point cut? You can see pretty high, 50-50-ish, just below that. And then even December, you can just see if we're down at 3.25%, for example, then there's a 1 in 3 chance really of a third rate cut. which of course has moved, I would say, if you look at 34%, yeah, 20% last month. So yeah, um, uh, really useful tool, and recommend you having a look at that. But whilst we're looking at that, then, or whilst even if you guys are looking at that, kind of ruin the punchline. Powell, of course, yeah, expectations were, let's just set the scene then, were before his speech on Friday, of course, that he would push back against the September rate cut odds, which had sort of pared back slightly to around 70% just before he spoke. But that was turned on its head, really, as I said, a pivot, a flip flop, whatever you want to call it. He effectively endorsed market pricing basically when he sided with this dilemma that they have at the Fed, the dual mandate. So that is, of course, maximum employment versus price stability. And obviously, we've had upside risks in inflation, price stability because of tariff-induced inflation potentially, versus then a softening labour market. And of course, the most recent non-farm payroll report and those revisions, dramatic revisions to the previous 2 months' data as well. Powell, what did he do? Well, he effectively, by endorsing market pricing, then he sided with weakening labour markets over that one-time sort of price adjustment in inflation due to tariffs, and really any more persistent inflation stemming from higher inflation expectations. The key phrase, just for your guide, he said downside risks to employment are rising, and with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Of course, he didn't pre-commit to anything, but it was a very clear signal for a rate reduction in a few weeks' time. And it kind of did surprise markets and Wall Street. You can see that just from the reaction that we saw. The 10-year US Treasury moved down to sort of 4.25% from 4.33%. The 2-year Treasury yield is kind of stuck, really, because it's priced in pretty much that cut. It's just the high chances of the cut just moved sort of 70% plus. But then we did see, of course, the dollar fall sharply as well. That came off sort of around 1% against some of the major currencies. And really, the speech supported those conclusions made after that July jobs report that the Fed, of course, could move in September after all. And also, then it comes at a time when the market is largely kind of priced out expectations for any further easing from the ECB, and at a time then when the market is seriously considering another rate hike from the Bank of Japan in October. So rate differentials playing a part now, yeah, that is key for potentially the dollar moving forward. I think just one point I wanted to make about the dollar is really, yes, what we've seen over the last few months, actually. Generally, of course, exchange rates tend to follow interest rate differentials, and that's what we talk about sometimes on the daily commentary. So higher yields attract flows from currencies with lower rates. That all changed, of course, around Liberation Day when you saw the dollar sink as yield differentials rose sharply in its favor. That was essentially down to basically a no confidence vote in the US. And yields rose essentially because people were nervous about keeping money in the US. Kind of good news then is that sort of crisis of confidence is pretty much over for the time being. At least the normal correlation then is back in force. So rate differentials you may hear a lot more about. The bad news, of course, again, is that rate differentials are shifting against the dollar. So yeah, just a sort of dollar lesson there. And just about interest rate differentials, yield differentials you might hear about as well. They're just the differences between interest rates in those currency pairs, if you like. Just on Jackson Hole then, of course, we still have one more non-farm payroll report, one more CPI report as well in the weeks leading up to that 17th of September FOMC meeting. Non-farm payroll on the 5th, then the following, that's the first Friday, of course, of September. And the following week, I think on the 11th, we get the CPI report. And then the following week, we get the September Fed meeting. So should be a really interesting few weeks ahead. Interesting as well, I think Fed speakers just on sort of Friday late last week were not as convinced about the prospects of a rate cut, just for your guide. So one of the non-voters cautioned that the Fed is still missing badly on the inflation mandate. Inflation has been sort of 3% around that level for I can't remember, a few years essentially. I was trying to think of the number of months, but it's a lot of consecutive numbers of months. And we also had another voting member actually of the FOMC who said the next jobs report may or may not be enough to justify a rate cut. So as I said, all eyes on NFP, non-farm payroll reports, first week in September, then the CPI, and then of course the Fed meeting. Okay, moving on from Jackson Hole then, we did have just quickly some data out last week, UK inflation data, and just for your guide, here's the chart just before those numbers came out, kind of reality check really after the hawkish cut that we saw at the Bank of England 7th of August meeting. So prices again printed on the higher side in the UK, headline rose to 3.8% from 3.6%, so this red line going higher. And then core CPI, that rose to 3.8%, the grey line from 3.7%. And then services actually accelerated from 4.7 to 5%. Kind of some economists saying it was due to rising airfares, not food inflation, which the MPC cares more about, but still quite a dilemma then for the Bank of England and money markets. Well, they already doubted whether the Bank of England would be able to continue policy normalization at its current, if you remember, quarterly 25 basis point pace. And that sort of continued with more doubts over more easing, I guess. Sterling gains, well, that saw immediate gains after the release. Euro sterling popped lower, really. And if we just look at, let's look at cable actually. I'll just bring that up, and also Euro sterling. So let me just grab the chart. So here's cable. And we got, just a few days sell off actually after the CPI report, just dollar strength really into Jackson Hole, and then obviously the pop higher, dollar losing ground, and every major currency gaining against it. And you can just see now we're just sort of trading around the blue line, that 50-day moving average at 134.89. We did find support then at the first fib level at 133.86. Also in here, I've got this swing high from September of last year. That's at 134.34 where we found support as well. So sort of next upside level, just around 136, 135.94, which is the high from a couple of Thursdays ago. And then you've got the highs from late July, around 135.84, 135.88. So that'll be initial resistance, you'd think, before then potentially this multi-year high at 137.84. Otherwise, support, as I said, just below 133.86, 134.34 as well as a marker. Euro sterling, like this chart actually, so bring this up. We found support again at the 50-day moving average. That's now 86.31. The fib level, the minor fib level of this move higher, that was at 86.31 as well. So we dipped below it, but sort of decent support around that area and just around 86. And then you've got that long-term high from end of July. That's at 87.52. That's euro sterling. Okay, moving on from that to the RBNZ meeting actually last week as well. They lowered rates as expected by 25 basis points to 3%, but it was very much a dovish cut actually. So the split vote was interesting, 4-2, two governors in favour of a larger 50 basis point cut, which was seriously debated. Inflation currently around the top end of the 1 to 3% target band, but expected to return to 2% by mid next year due to spare capacity and declining domestic pressures. Economic recovery stalled in Q2 with global policy uncertainty. falling employment, and declining house prices all contributing. The MPC indicated scope for further OCR reductions if medium-term inflation pressures continue to ease to help the economy and the labour market. We had updated projections as well for the policy rate. They suggest short-term potential towards 2.5% by Q1 of next year, and that compares actually with 2.75% in the May update, before then returning to the neutral sort of 3% at the end of the policy horizon. Was an interesting meeting really, because this bank faces basically the same battles as those faced by the Fed and the Bank of England in terms of how does it react to higher short-term inflation. Certainly neither of those two, the Bank of England and the Fed, have the same spare capacity in labour markets as New Zealand does, but the reaction in Kiwi FX really in rates markets does kind of serve as a reminder that if the labour market does show serious signs of softening, which we talked about, of course, then doors do open for central banks to cut rates to neutral, or even, of course, below neutral. And then you get a sharp sell-off in the currency. It's kind of what we saw last week, but we did dip down to support. The black line then is a 200-day moving average. That's a 58.32. Corresponds with the 38.2 retrace level of this move lower. That's a 58.25, so decent support around there. Upside resistance, well, the halfway point of this moves at 59.31, and then you've got the 50-day moving average of 59.69. That is in Kiwi dollar. Just briefly as well, we had some PMI data, always important sort of lead indicators, have been historically for global economies really. Just for your guide, this is obviously the numbers before the print in the US. Flash PMIs for August, they came in stronger than expected. So manufacturing rising above 50, actually strong number, 53.3, consensus 49.7 expected. That was manufacturing, so much higher than expected, but then services did fall actually to 55.4 from 55.7, but still above the consensus number of 54.2. Increase in manufacturing due to higher newer orders, which was interesting. The output index is actually at the highest level in more than 3 years, and details generally were very strong. So decent numbers there. In the euro area, the PMIs were positive actually, composite rising to 51.1 versus expectations of 50.6. And that's from 50.9, basically due to a rise in manufacturing, actually, while services declined. Was also a milestone then for euro area manufacturing, actually, as it recorded growth for the first time in more than 3 years, so above that 50 boom bust sort of level we've been talking about, again, due to a rise in new orders and output. Services did decline, as I've said, 50.7, that print, below the 50.8 expected and from 51.0, but still kind of an overall decent enough report. So that's the PMIs. Just moving on then to this week's main events. Firstly, we get, well, the main probably event, although it will be interesting because obviously we've had Powell saying he's going to look through inflation potentially. And dare I say it, he's calling it transitory, although he didn't, of course, use those words. But possibly we're looking through inflation data now and waiting for the employment numbers instead. Will be interesting if we do get a pop higher, just because of this tariff-induced effects, just short term at least, then how the market reacts, of course. But anyway, Friday, yeah, we get the Fed's favored inflation gauge, US core PCE. The headline expected at 0.2% month on month, core 0.3%. And then the annual core PCE number should lift to 2.9% from 2.8%. Of course, we had CPI before that, and also PPI. And PPI was the one which sort of was hotter, much hotter than expected, although a lot of those details don't feed in too much to then the core PCE reading. But of course, it's all about, again, as we've said, US tariffs and whether they're continuing to generate cost pressures in the supply chain, and then whether consumers feel the impact of that. Not happening just yet, so yeah, it will be an interesting number. Companies are expected to pass tariff costs to customers, though current sort of demand limited full pass through is limited. As I said, Powell said they're sort of one-time price level effects. So yeah, interesting that, and that's what we got from the minutes actually, and also obviously from him on Friday. But as I've said, other officials have warned of persistently elevated inflation, and difficult to separate from underlying trends. Just for you guys, the Fed's June projections for core PCE were seen rising 3.1% year on year, before then cooling next year to 2.4%. In 2026. We just pull up then the dollar chart. Let me just grab that. I always say this, but this is the DXY chart. So it's an index of the six of the biggest trading partners of the US. By far the biggest weighting in this index is the euro, around 56%. So always remember that. Otherwise, you can see the blue line has capped the upside previously. We did move above it, but now we're trading around it. That's at 98.06. You've got the first minor fib level at 99.63 above, capped the upside end of July, start of August. And then I've got this swing low in here from July 2023. That's at 99.57. So that should be strong resistance again. Otherwise, support, if we do lose Friday's low, 99.55, then potentially, we've got these lows in here from late July, 97.10, and then that's long-term low at 96.37. Again, just for your guide, you can see this dotted line in here, very long-term support level from the 2011 lows, then touch the 2021 lows, and it just comes in just above probably that long-term low, as I said, at 96.37. So that's the dollar index. Just briefly as well, let's just get to Aussie CPI data. That's released on Wednesday. July monthly CPI, that's expected to rise 0.5% month on month. That should lift the annual rate to 2.3% from 1.9% actually. In line with the market consensus, I think it's a range of 2 to 2.7. June, for your guide, that printed 0.2% month on month, 1.9 year on year, softer than both expectations. And the RBA's August projections actually for headline inflation saw it climb above 3% in the second half before easing back, with trimmed mean CPI at 2.7%. So that's still at the top end of the target range of the RBA's 2 to 3%. Markets will focus on whether basically July CPI confirms those upside pressures or signals basically a contained rebound. A stronger than expected print could possibly push back RBA easing expectations. I think a lot of economists cite electricity costs remaining the key swing factor. Markets, they see around a 1 in 3 chance, I think, of a 25 basis point cut at the end of September RBA meeting for your guide, just higher than 1 in 3 chance, around 38% chance, I think, of a cut on the 30th of September RBA meeting. For the Aussie, pulling this back, you can see we found support at the halfway point of this move lower from those highs in September last year down to the April lows. Halfway points at 64.27. That dotted line just below there is the black line, the 200-day moving average. That's at 63.84. And then above, we've got the 50-day, the blue line, that's at 65.12. And then the 61.8 retrace level, big Fibonacci level, that's at 65.49, which has kind of capped the upside over the last few months, really. So tracking sideways, really, the Aussie at the moment. Okay, just before we wrap up, we also have Tokyo CPI. That's out on Friday. It's obviously a forerunner, basically, for nationwide CPI. August numbers expected to slow to 2.6 from 2.9%. That's driven by softer energy prices, though fresh food does remain firm. Then the core number, that excludes food and energy, is projected to stay, though, above 3% still. That basically shows underlying price pressures still remaining elevated, kind of reinforces that case, the Bank of Japan case, that prices are on a sustained path towards or above 2%, sorry. Markets will watch basically for stickiness in services inflation, with upside surprises feeding into expectations for this gradual policy shift. Yeah, so this will play a part, of course, in those rate expectations for October, potentially, and a price hike, rate hike, sorry, by the Bank of Japan. As for dollar yen, tracking sideways over the last few weeks, you can see there, upside probably capped by the black line, the 200-day moving average at 149.03, and then again the blue line, the 50-day, but it has worked as sort of a support level, and that's at 146.83. Okay, I've just got a question actually, and I should have said, and my apologies, but just bear with me while I check that out. But also, if you do have any questions, please, please that you have asked them along the way. So just bear with me 1 second. No, yeah, no problem. You got in late, but did you miss gold? I think is what you're asking for. So let me just check out gold. Bear with me 1 second. I'll pull up the chart. Which again, yeah, I kind of write about these things in the daily. If you ever look at the daily report that we put out, put a chart of the day sometimes. Gold hasn't done too much, and you can see from the chart, of course, that we're tracking sideways around the blue line. I sound like a broken record, but yeah, that's the 50-day moving average. That's at 33.48, 3,348. Just tracking around that. You've got this descending trend line I've put in here, which comes in around 3,400 or so. So that may offer some resistance. Obviously, the all-time high is at 3,500. So we've got to break 3,400. The more we track sideways, I always say with some of these, well, with any price chart really, that range contraction, and the more we get range contraction, then the bigger the breakout range expansion we should get. But at the moment, we're still tracking sideways for gold, kind of looking for major catalysts, I would say. Of course, that sort of risk premium from some of the geopolitical issues kind of easing slightly, but then you've got the underpinning of support for gold by central bank buying, and we've seen that especially from China, consecutive months of bank buying, central bank buying, India as well, I think, and some of the other Asian central banks. So you've got that sort of underlying support for gold, but then as well, you've got the sort of easing off of geopolitical tensions, as I said. In amongst that now, we have rate cut expectations rising for the Fed, and you kind of think gold being a non-yielding asset, of course, will respond to that positively, you would think. But at the moment, yeah, we did get a slight rise on Friday, you can see there, but just nothing major. And really, yeah, 3,400, then 3,500, of course, the obvious levels. Support-wise, I've got in here a fib level from these lows, yeah, of December last year up to that 3,500 high, and the minor fib level, which does actually track some of the recent support, is at 32.83, with then the major fib level below that being at 31.49. Okay, yeah, I hope that's helped you with gold. As I say, I do write about it from time to time in the daily commentary that we have, that we put out on the website after the US close. And I always comment if there has been any interesting developments, certainly with ETF buying as well, which is always a key driver potentially for gold. If the ETF buying picks up, then that translates into prices on the chart generally. Okay, I'll wrap it up there. Hopefully, it's proved of use to you guys. Really do appreciate everyone being on the call for 40 minutes or so. Please do follow us on social media, and also that report I put out every day after the US close, as I said, concentrates on the dollar, stocks, more detailed look at the day ahead, and then that chart of the day as well. Okay, I'll wrap it up there. Thank you so much, and we'll speak to you same time next week.